As interest rates rise or fall, one way market participants manage their interest rate risk is by using TBill futures spreads. Trading intercommodity spreads involves simultaneously entering into two futures positions in a single order, one long and one short. Since both SOFR rate and TBill yields are used as benchmarks for short-term interest rates, the intercommodity spread between them is especially interesting for many traders. The spread price is calculated as the SOFR futures contract price minus the TBill futures contract price. This spread price will often, but not always, be a negative number. That is a consequence of the fact that the SOFR futures contract is based on a money market rate, whereas the TBill futures contract is based on a discount yield. Let's look at an example using the December 2023 contracts. The December TBill futures final settlement price is determined by the highest accepted discount rate of the 13-week TBill auction on Monday, December 18, 2023. The bills issued in this auction will mature 3 months later, on Thursday, March 21, 2024. Meanwhile, the SOFR futures final settlement price is determined by the daily compounded SOFR rates between Wednesday, December 20, 2023, and Wednesday, March 20, 2024, thus aligning closely with the 3-month rate exposure that TBill futures provide. How might a market participant use this spread to hedge their portfolio? Consider a portfolio that holds a long position in cash T-bills hedged with a short position in SOFR futures. Despite being partially hedged, this portfolio is exposed to asset swap risk because T-bill yields may respond differently to external market conditions compared to SOFR rates. To mitigate this risk, a market participant can use a SOFR T-bill futures spread to manage potential differences between the two rates. Market participants can also roll the spread trade forward at expiry if they wish to remain hedged. Let's look at a specific example. Say a portfolio is long Treasury bills with a DV01 of $100,000 and short SOFR futures with the same DV01 of $100,000 to offset some of the interest rate risk in the portfolio. This portfolio is still at risk of losses if T-bill supply suddenly surges or drops. To further manage this risk, the portfolio manager could implement an overlay strategy using a SOFR T-bill futures spread. Since both SOFR and T-bill futures contracts are defined by the IMM index with a DV01 of $25 per basis point, the portfolio manager could hedge their $100,000 risk by executing 4,000 SOFR T-bill futures spreads. Shortly after, suppose the supply of U.S. T-bills increases and T-bill yields rise by 5 basis points. This leads to a decline in T-bill futures prices. Additionally, assume the SOFR yield curve increases by only 2 basis points. Without the overlay, the original portfolio's net position would have lost $300,000, as the payout for the SOFR futures hedge would only compensate for $200,000 of the $500,000 loss incurred by the portfolio of T-bills. With the SOFR T-bill futures spread overlay, however, one can expect to be much more closely hedged, given that the T-bill yield rose 5 basis points and the SOFR curve only gained 2 basis points. The spread between both would have theoretically increased by 3 basis points. The 4,000 contract overlay at $25 per basis point would have compensated the investor for the remaining $300,000. When it comes to navigating interest rate fluctuations, SOFR T-bill futures spreads provide one way to manage this risk. For more information, visit cmegroup.com/T-bill spreads.